So today we're talking about the two pieces of exposure draft legislation that Treasury released yesterday as part of the multinational tax integrity package. And those two measures cover ThinCap, which is Ben's sweet spot, and he'll talk to that, as well as disclosure of subsidiaries' tax residency information, which I'll talk about. We're going to cover what's in both the drafts, what surprised us, and where to from here. So both of these measures were announced in the October budget last year. We don't yet have the draft legislation for a couple of measures. So the intangibles measure, which is to deny deductions for payments where intangibles are held in low or no tax jurisdictions, or for the public disclosure of parts of C/C reports. So all of these measures have been announced to apply from 1 July 2023. So with only about 3.5 months to go, there is a lot to happen over that period of time. So Ben, first to you on the ThinCap measure. Can you give us an outline of what these changes are?
Yeah, sure. So in last budget, we found out the ThinCap rules were changing. So we currently have an asset-based test, and we're moving to an earnings-based test. So similar to what the US and the UK have, all three tests are going to be replaced. So firstly, we're going to have a fixed ratio test, which will be your interest deductions will be capped at 30% of a tax version of EBITDA, and any denied deductions can actually be carried forward for 15 years, subject to a modified COT sort of test. Interestingly, no capacity can be carried forward, similar to some other regimes have. And then we've got the complement to what was the worldwide gearing test. We have the group ratio test, which in effect looks to the gearing ratio for third-party debt across the global group. And if the interest deductions are in excess of that for each of the entities, then the excess will be denied. Now, with that test, only third-party debt and no carry forward of those denied deductions. And then the third test, which is the external third-party debt test. Now, this is the replacement of the ALDT and is a much narrower version of the ALDT. So rather than look to what would a hypothetical taxpayer be able to borrow, this relies on the credit assessment of third-party banks and says that you can claim all the interest deductions for your third-party debt. However, there's limitations on which debt is in there. Pretty much vanilla senior debt, can't have any fancy guarantees or any credit support mechanisms. And the real issue with this one is that you can only use this test if all of your associates also use this test. And there's a very expansive definition of associate for this purpose, and includes anyone who you have a 10% equity stake in. So could be quite broad there.
Right. Yeah, that's a really interesting one in terms of the associate test and how that might play out. We've obviously been sitting on this announcement by the government since the budget back in October. Maybe can you take us through whether there were any surprises in what we saw yesterday compared to the announcement? What's catching people by surprise, and what's drawing interest that might be the subject of submissions?
Yeah, sure. So there's two key surprises here. So starting with the winners. So the superannuation industry was able to get a carve out here. So previously, given the size of the funds now, and because they're going offshore, they have been in positions where they have caused some of their investments to be subject to ThinCap because they're associates of them. The associate rules will be modified, so therefore super funds will no longer cause their associates to be subject to ThinCap. So a win there. However, the corporates aren't going to be so happy. So there's been amendments to 2590 and the TOFA equivalent, which, as a reminder, was if you have debt that has been used to fund a foreign acquisition and you get named returns from that, you can still claim an interest deduction for that. Unfortunately, that's going, which will return us to the world of having to apportion debt between the assessable and non-assessable, and potentially having to try and quarantine your debt, which I think is just going to increase compliance costs there, and also a denial of further interest deductions.
Yeah, interesting. So there's obviously a lot to think about, as we come towards 1 July, which is the start date that's proposed for all of these measures in a general sense. So what are organisations thinking about doing in the next few months to be ready for this legislation, assuming it passes in something like its current form?
So I think the next 4 weeks, there's going to be a lot of submissions on the pain points here. At the same time, we'll see taxpayers doing calcs as to see how these rules affect them and whether they can fall into some of the backup tests. And then I think there's going to be a review of the capital stack to see how this is going to work for you, for corporates, how much of interest is going to be denied. And then I think there's going to be some difficult discussions amongst consortiums where there's a mix of domestics and foreign investors, and shareholder loans might be causing some potential issues here that it previously wasn't.
Yeah, interesting to work out how the pain might be shared around in those sort of structures where there's investors who have different incentives and quite different outcomes under these new rules.
I think so, Andy. And think at the same time, we've just got additional compliance obligations. Do you want to take us through some of what happened yesterday in that regard?
Yeah, so the second measure that we saw draft legislation on yesterday was around the disclosure of subsidiaries' tax residency. And so this is a measure that is relevant for Australian public companies, either listed or unlisted, but in a large part listed Australian companies, so ASX companies. And this is a tax transparency measure with the idea being that with the release of information around tax into the public arena, there'll be a bit more pressure in order for there to be less tax aggressive structures that large companies are adopting. And so the measure is going to apply by requiring Australian public companies in their financial statements, so at the end of each reporting year, to disclose what the tax residency is of the subsidiaries that are consolidated in those financials. So that's initially an accounting question to work out which entities this covers. But if you think about a big ASX listed company, all of the entities that are consolidated into their financials are the ones that disclosure will need to occur for here. And what the disclosure is going to require is essentially a listing of all entities that are controlled. And there's already a listing of that sort of kind in financial reports. Normally towards the back, there's a disclosure note that's titled related parties or something like that. And it lists out all the entities by name and what the ownership percentage is. And so now this measure will also require for each of those entities a disclosure of what its tax residency is. And that might be one country, but it might also be multiple countries rather, where you have dual residency. So that disclosure is going to be required for financial years commencing on or after 1 July 2023. So for years starting in a few months' time. What that means is those first years will end in July next year, 2024. So come FY24 reporting season around August next year, this sort of information will start entering the public arena, and it'll gather some media attention at that time.
Yeah. So Andy, other than calling your comms and marketing team today, what do you think companies will be doing in the next little while?
Yeah, well, to put it in a bit of context around these tax transparency measures, the ATO already discloses information about companies' tax paid and taxable income and revenue each year. So there's a data dump essentially that occurs by the ATO, and there's often media attention at that time. What some of the larger organisations are doing is they deal with issues like that in their tax transparency report, which they voluntarily issue each year. And so we've seen to date companies dealing with things like explanations around what their accounting income is and what their income for tax purposes is and why those are different, and therefore explaining why they don't just pay 30% of their accounting income as tax. So that's how companies have been dealing with the disclosures that already happen. We think that there'll probably be a similar means for dealing with these subsidiary tax residency issues. So, for example, if a corporate has subsidiaries where it's going to need to say that they're tax resident in a tax haven or something that people might consider to be a tax haven, they will possibly get on the front foot in those tax transparency reports and maybe be including statements around why they have tax residency in those countries, whether it's an acquisition from somebody else's structure or a subsidiary they had in those jurisdictions they no longer use, or for some other purpose. So possibly dealing with those things in those reports in that way in advance. It's also the case that some organisations don't deal with this in advance, and so they're going to, like you said, need to be ready to deal with it from a PR perspective if there's media attention later.
Yep.
So interesting times, couple of releases yesterday. There's obviously, as we said, still the couple of measures which we haven't seen draft law on yet, the intangibles and the release of some public country by country reporting data. We expect those will come quite soon, given there's only 3.5 months for this legislation to be put out in draft, commented on, passing through Parliament, and then live come July. So, Ben, thanks for getting on the video today. Obviously, lots more to discuss over the coming weeks.
Thanks very much, Andy.